you once again. Thank you once again for being here. My name is Raquel Redding, the Vice President of Community Development here at NCST. We are excited to have you here to talk about a report that our partners in Pittsburgh have done. We'll be introducing Ernie Hogan formally in just a few minutes, but I am joined by my colleague, Elizabeth Coates, the Director of the Homeownership Alliance, who is going to do our introductions for us. So Elizabeth, with that, I'll go ahead and hand it over to you.
Thanks so much, Raquel, and welcome again, everyone, for joining our July Community Impact Briefing. As Raquel had noted, and as you all saw from the invitation, we are so pleased to have Ernie Hogan, the Executive Director of Pittsburgh Community Reinvestment Group, joining us today to share some really important pieces of data that PCRG has put together. After a decade of research, a culmination of data analysis reveals continued decline in the Black homeownership rate in Pittsburgh and in Alleghany County. Several factors, including segregation by household income, increases to the median home values in Pittsburgh, and continued corporate purchases of affordable homes, are identified in PCRG's report Taking Stock, a decade of decline for Black homeownership in Pittsburgh, as contributing factors to the growing decade in Black homeownership rates. So Ernie will share the results of their latest report and discuss recommendations that PCRG is making to create a statewide Community Reinvestment Act in Pennsylvania. And this would apply to banks, credit unions, and other non-depository lenders with an enhanced focus on racial equity. And I would be remiss if I didn't mention that PCRG has also joined the Homeownership Alliance. They have been a tremendous addition to our work, have provided really in-depth policy knowledge and practical knowledge on how to ensure that the practitioner perspective, particularly as far as homeownership is concerned, is elevated at the federal level. So thank you so much, Ernie, for joining us today. I will hand the reins to you.
Thank you both. And I'm really honored to be able to share our research and our work. And PCRG very much values our relationship with the National Community Stabilization Trust. We've been a partner since the creation of the trust and now joining the Homeownership Alliance and the good work that it's advancing. I appreciate you and all of our partners out there. So with that, let me share my screen because you really want to look at this and not me. And let's get started here. All right, so hopefully this will work. So as I said, welcome and thank you all. And let me just give you a little background. So the Pittsburgh Community Reinvestment Group is about a 36-year-old coalition of community organizers. We came to being from 8 members who originally founded us. We basically are fighting for the economic justice issues and racial justice issues of Southwestern Pennsylvania. And we continue to grow with that base. Today, I want to just review quickly some of the things I'm going to talk about, a little bit about us, talk a little bit about the Black population trends in our region. We've been studying this work now for almost 3 decades, as was pointed out, and we have been analyzing Black homeownership and the differentials on why the challenges of Black homeownership and home purchasing trends and what's happening there. We also will just run into a quick explanation of some of the factors we've determined. I want to talk a little bit about some of the tools that are out there that we're using to change that paradigm and some of the policy actions and strategies, as you heard, that we're working on to sort of again, and cement this in a positive way forward. So, like I said, we are a membership organization. We're driven by our board of directors is made up of the membership of the community organizations of which are our members. We do not have banks or government on our board, so we are truly a community-led organization. We've been around since 1988. And we currently have members in 3 counties in the region and continue to grow and expand. We are really a research and advocacy organization, with advocacy being influenced by our research and then underpinned by our technical assistance support and education of our members to be able to be an active and participant member of the coalition. So let's get into sort of some of the statistics that I wanted to share with you so that I can leave some time for questions and Q&A. But in the end, Allegheny County, we looked at a 10-year cycle of population. So in 2020, Allegheny County had the highest Black population of the surrounding counties of the area we studied, with 184,000 at that time, followed by Beaver County and Westmoreland County, respectively. The highest change in population and the Black population was experienced by Beaver County, where we saw the population jump from 2010 at 7.34% to 8.4%. And I'll talk a little bit about some of the trends and why that was happening. We also saw some of the areas around us with some of the most significant population losses, which was the city of Pittsburgh, Rankin, Braddock, Homestead, Swissvale, and being the city of Pittsburgh with the largest population drop of roughly 8,156 people. Some municipalities saw increases, and why is that happening? We've looked at some of the migrations of the populations in the region, and we wanted to understand that. And that report just recently was released in the last 2 weeks. So with that, we saw increases in neighborhoods like Penn Hills, and these are outside the city of Pittsburgh: Monroeville, McKeesport, McKees Rocks, Stowe Township, Wilkins Townships, and Pitcairn all saw increases in Black population. And why is that? These also saw decreases in white population. So you're starting to see the effect of Black to white flight kind of conversation. The other big changes that were happening in some of our communities within the city of Pittsburgh, we saw, and some of this we attribute to gentrification, but 500 plus decreases was East Liberty, which was a huge urban renewal area in the 50s and 60s, saw a real investment and rebound by the city, where it remade its public housing and strategies to a neighborhood that now boasts scenarios where before housing prices were very low, maybe $15,000 to $20,000, and today are seeing housing prices for for sale homes approaching $1 million. Highland Park, Terrace Village, West Oakland, primarily a housing authority community that's been remade. Upper Lawrenceville, Point Breeze, Garfield, and others, also major population decreases. Other communities that saw the influx in the city were Carrick, Northview Heights, which has a large public housing community, Brookline, Esplin, Sheridan, Southside Flats, Carrick, and Highland, and so on. Also, these communities all saw increases of 500 plus. So I want to just sort of review the chart a little bit here as we've been going on. And it's kind of interesting as we start to look at this. So if you look at the population across the different counties, we looked at this, and you look at the first segment. This is the Black population over the last 2 decades, from 2000 to 2010, and then 2010 to 2020. You started to see a population increase in Allegheny County, a Black population, and you saw an increase in other counties, but you saw, in some cases, decreases, like in Armstrong, and you saw an increase in Beaver, Butler, and so on. Respectively, home ownership, the same rates, if you look at them compared to the whites in these counties, you see a consistent downturn of Black home ownership in Allegheny County from 39% in 2000 to 32, almost 33% in 2020. And then also you saw a flat home ownership rate of whites in Allegheny County, but you start to see some of the surrounding counties where you start to see population growth, and in some cases home ownership rate growth, or at least flat. Butler was one of the few that we saw an increase in Black population, but a a decrease in ownership for a minute and then sort of starting to grow back up. So paying attention to that. Also, the city median Black homeownership rate was roughly 25.2% in 2010, where it was in 2020, we saw it grow to 26.76%, almost 27%. Those are significant changes. So we saw a decrease in population, but an increase in ownership rates in the city. Interesting. The other things we looked at was some of the breakouts as far as how this sort of broke down. And we looked at the 2012 data of 81% of Pittsburgh MSA Black mortgage loans originated. And in 22, we saw a decrease. So over that decade, we saw a decrease significantly. But on the other hand, we saw an uptick in the surrounding counties around Pittsburgh where they were purchasing. And we believe some of that is because of the trends that are happening with regards to the migration of the population. And another interesting stat is that we've seen a general uptick of Black population in our region overall, except for one county across the area. So this is similar. We saw similar trends outside with regards to the increase in Black single-family home purchases between 2012 and 2021. So we started to see growth in that area. Other counties, on the other contrary, the city and Penn Hills and Moon Township are all experiencing the high relatively declines of home purchases. And we can talk a little bit about that because we think a lot of those are seeing significant home sale price increases as part of the delta to that. Where the other areas where we saw the experience of growth, those are in some cases lower wealth or had other opportunities for ownership at more affordable prices. The other big thing that stays consistent, and we continually track this, and is interesting because it's equal across the border on many cases. The report shows and talks a little bit about this in the denial rates between Blacks and whites. So we still have a the denial rates of African Americans to Blacks is still 2 times that of whites. But the categories for denial are still the highest denial rate is credit standards. The second is DTI, which is income to debt. And a lot of that cases is being driven by student loans. It's being driven by consumer debt. It's being driven by lower wages in some cases. And then also the asset base. So we're seeing, meaning that the buyer doesn't have enough cash on hand, or the asset that they're trying to buy is not appraising, which speaks to some of the appraisal biased issues. And we're currently doing some analysis and research on appraisal bias. So as I was saying, it's kind of been an interesting factor. The other piece in this whole thing that we're thinking is contributing to, and I'm sure a lot of you are seeing this in your communities, but we're seeing that the corporate home ownership, corporate purchases in our communities. We just did a study back in 2021, 22, we released it. We looked at data on this, and it's on our website if you want to go look at it and play with it. But basically what we were seeing was corporate purchases from 10 to 21 went from increased by 15.5% of the sales to, in 2010, 24.8% of the sales in 21 were corporate purchases. So 20+% of most of our low wealth and African American communities saw increases in corporate purchases in these communities. Taking valuable inventory that would probably most likely be opportunities for families to make homes and move on and build wealth. We saw a pretty big delta shift there. We also know that Pittsburgh remains in Pittsburgh and the remaining parts of Alleghany County. Many of these census tracts have our higher share of corporate purchases historically, especially in our LMI and Black communities. The report also went on to talk a little bit about that these entities are actually, because they're cash buyers, are actually buying at a reduced price, almost 70% on average of the value of what the sale price should be. So they're not only doing that, but they're also creating and forcing wealth drain and stress on these communities that they're buying in by forcing the prices down, which we're worried about what the alternative is down the road when they decide to sell. So with all that said, we started to look at how do we change this delta? One of the big things, we know Black homeownership has been on the decline. We know that some of those issues are around wage disparities. And we know that our affordable housing inventory is a big problem for sale. And that came due to a lot of the initial Great Depression during 2009 through coming out of it in 2012. A couple of things that have helped change our trajectory, and we've recently seen a 2% increase in Black ownership in our region. And we think that's in part to some of the things we've been putting in place. One is utilization of the Special Purpose Credit Program. This is an initiative that was created by the regulators of the banking industry to allow them to target gap populations that are having issues with access to capital. And about a year and a half ago, the three regulators issued a guidance memo collectively, which helped bring some understanding and protections to the institutions that decide to move these. PCRG has been working with many of our institutions around that. I'll get into some more of that. Local land use policy was another area of action. So creating a land bank. Many of you probably have land banks. We don't, and we're currently just birthing one in Pittsburgh. We have over 24,000 vacant parcels. Federal regulation, the new CRA Act, and as you heard, we're looking at exploring creating a statewide CRA with our friends across the state. And then recent, federal legislation opportunities, one that we're working with the Home Ownership Alliance on, which is the Neighborhood Home Investment Act, to provide resources to renovate and build new affordable home ownership. And expanding home ownership production is another avenue we're looking at. So let me just go into this. I talked a lot about this already. SPCs historically are targeting disadvantaged communities. This can be both for home ownership and business lending. We've seen several products in our region where we've helped local institutions create these, already seeing upticks in their Black lending going up. And part of the memo of guidance was giving them real understanding of the provisions of the Equal Credit Opportunity Act and weaving fair housing issues into that, ensuring that it was perfectly legal for the institutions to target these populations to increase the numbers. And then lastly, just the education of the institutions is something we've been doing. Some of these SPCs are as simple as enhanced down payment assistance targeted to these gap populations, lowering credit scores and other scenarios to make the products a little more fitting for the population they're trying to serve. Our land use policy, what we've done is really tried to build equity into our land bank, creating a scorecard mechanism where we can actually rate the reuse of the properties, putting homeownership, affordable homeownership as a priority of reuse of the recycled land through our land bank, as well as examples of targeting public subsidy for down payment assistance and other things with regards to that. We've also been moving forward inclusionary zoning strategies. Our working groups where we have these conversations have been around our vacant property and blight working group, which has been in existence almost 25 years now. Our Black developer cohort and helping build real capacity within the minority development system to actually help address some of the gap of new units in our communities. And then our two bankers councils where we bring banks and communities together to talk about these issues and the challenges and give bankers insight to the barriers in communities and give communities the insight of the challenges and regs that banks work within to really sort of level the playing field and become equal partners. On the federal regulation side, we're quite excited. Although the Community Reinvestment Act rewrite of the rule, we didn't change the act, but we did change the way the rule to modernize it to today's standards. Hadn't been changed since 1995. We've been working on this with national partners for almost a decade. The rule was released last fall in October. A couple of things to understand: that CRA pretty much drives between 300 to 400 billion a year in loans to low and moderate income households. So we know that this is a very powerful, this is higher than the annual budget of HUD or the Department of Transportation or the Department of Education. So you can see the value of what Community Reinvestment Act could mean to a lot of our low wealth communities and how we can drive that. We know that under the new CRA, there's a couple interesting things that came out. For large institutions, SPCs, the Special Purpose Credit Program, now are qualifying and give bonus points per se for large banks who do the programs in their new CRA assessment. So it gives us another tool to help encourage institutions to create programs to help serve these gap populations. The state level CRA is an interesting thing we're exploring. One of the things is mortgage companies and credit unions don't have CRA, and I don't see that happening on a federal level for a very long time. Their lobbyists are pretty influential and strong in DC. But we do think, and we've seen where states like Illinois have passed this, and they're already seeing an increase by covering credit unions and mortgage companies to include goals and objectives for increasing and being balanced in their lending across markets. Some will argue that they already do that, but it's better to have them at the table with the same rules and regs as their competitors so that we can really start to look at ways to change this delta of Black ownership. Pennsylvania does not have such a law. Other states that have enacted such CRA laws are Virginia, West Virginia, New York, state of Massachusetts, Connecticut, Rhode Island, Washington, and Washington, D.C. have all added statewide versions of CRA in various different attempts. On the federal level, we think some of the solutions are the Neighborhood Home Investment Act. As we continue to work with all of you as part of the Alliance and we'll create this tax credit. We also are looking at FHA lowering its annual mortgage premium is something we're advocating for, and go back to the old rule where once you had reached 76% loan to value, the insurance can go away. It just seems fair. We're penalizing families with lower credit score with a lifetime insurance premium that they probably shouldn't be paying. On the same note, first generation down payment assistance programs are really targeted at how do we move those to 120%. We're seeing that our working class families have the same challenges of saving and aggregating the money for a down payment. And we really should push program lending down to really the working class families. And 120% of area median income is still well below higher wealth families. And then also, we're looking at the HUD Home Investment Partnership and how those initiatives can be changed, especially around rental housing and providing homeownership housing opportunities, and working with our housing authorities to think about that. So with that, I will turn it back to the forum to see if there's questions. I can put our email or our website address, but I will tell it to you too. It's www.pcrg.org. And if you go to our research tab, you'll find a lot of our lending studies, the Black Homeownership study, the corporate study, the migration study, and other things all posted there. And it goes back at least 10 years worth of work. So you get any insomnia and you want some time to read and put yourself to sleep, feel free to pull the stuff.
Ernie, thank you so much for the presentation and the information that you shared. We're going to open it up now for some Q&A. So I think Elizabeth had put in the chat. Feel free to put that in the Q&A section or the chat on questions. I had a couple that came up as you talked about, like who's purchasing, who's actually getting access to the inventory, Ernie. So here's a question for you as it relates to the corporate buyers, and how much of that inventory is actually going into rental portfolios, or is it being flipped out for another sale? If you have any information on that, I'd be interested to know more on what's actually going back into housing supply for homeownership.
Well, what we're finding is land banks have been a good source in a lot of cases for really rebuilding the inventory of homeownership. What I would say, though, is the corporate purchase side, we're not seeing the same outflux. We've recently done a data dump, and our analysts are working on mapping all of the code violations to the corporate ownerships to see if there is a trend of disinvestment. But what we're seeing is they're purchasing low-value homes at a below-market value, cleaning them up, in some cases painting is a minimum, and then going after public subsidy vouchers from the housing authority or others, and really raking in a high rental income compared to the delta of the purchase on the house. So they're really, in some cases, artificially holding back these minority communities and low-income communities, with the understanding that we're more worried about what does the outcome or the result mean if they decide to liquidate, if they can start to push value up. They could do that slowly by selling off some of their low inventory to push sale price up. And then if they were to then really move that through, they could really, off the back of our low-income communities and minority communities, turn a pretty interesting 30 to 40% profit pretty quickly.
And when you think about, when you say the discount and the purchase prices, it makes me think about, again, the housing stock, the age of the housing stock, the typical repairs or renovation work that needs to take place on that property. Do you have a sense, or can provide us with a sense of the average age of what you're seeing in Alleghany County and maybe other counties as well? Because I mean, I imagine it's older housing stock because it is, Pittsburgh and Pennsylvania, but.
Well, Pittsburgh, it's interesting. Our housing stock on average is about 80 years old or older. So it is much older, traditional. Our cities were built primarily during the first, 1920s, 30s, pretty quickly. But the 1900s was the big growth factor for our region with the industrial age. Most of the communities we're talking about and most of the corporate sales are like $75,000 in value and under that they're buying. They're not buying $150,000, $200,000 houses. They're buying the house from, my grandmother who might have passed away, and the kids have no interest in being back into the community. And so the house goes up for sale and a corporate purchaser buys it immediately. Those homes are not returning to the system at this point. And in some cases are holding down market. I did notice in the Q&A, there's a question about what was the impact of COVID stimulus. We did see some impact on that. A good example is we noticed that our own program, Detroit, had a very similar program with down payment assistance. Those programs have seen an influence where we were able to really increase the down payment programs out there. And some cities were really aggressive at getting the money on the street. I think in Pittsburgh, we put 60 million on the street from our stimulus dollars from the some of the COVID and the Inflation Reduction Act dollars that came in and are still funding those. Matter of fact, through some efforts and the vision of our mayor in Pittsburgh, they recently floated a housing bond, which they generated about $40 million that they're plowing into both a production of new affordable rental housing, but also affordable home ownership through continuation of these down payment assistance programs that were launched. Plus, the local housing trust also has a home ownership assistance grant program that's been happening. All of these have come from that, and we see that as a real key in sort of attacking that one denial rate, which is that asset-based denial rate for our lower income families and our Black families, where they just don't have the capital and can't aggregate the capital. Because to buy a house today, to be real, out of pocket can cost about $12,000 to $20,000 for an average home, for a low wealth family. And so how do we raise that? To raise that as a working class family is it take them 13 years to raise that money. You save that kind of money. So yeah, I see it.
Did you see the other?
Yeah, so the other question I see, they're asking about the city being more aggressive with code enforcement. So part of the problem with the LLC purchases and Pennsylvania, we did some advocacy work and finally the law passed. So it will change actually in the 2024 tax filings. All LLC corporations will now have to report to the state with their filings who the principal owner is of the corporation and their phone number and contact information. We hope this will actually allow municipalities to actually find these owners, because a lot of cases, the LLC is owned by other LLCs or corporations, and they don't have to, in their corporate documents, unless you really are diligent, go way, way back. And we've done some of the searching on these more notorious ones that have larger holdings to try to find the owners. And we literally had to go back probably about 8 or 9 layers deep to find any indication of who really owns this stuff, because they're owned by other corporations. And our corporate laws in the United States, they're very few, but some states have really strong corporate disclosure acts, and is an area that I think is a growing point for policy for us to think about. But a really good question.
That's a great point. Let's see if there are any other questions from folks. Q&A or chat.
Yeah. One of the things that we've been hearing a lot of is the production model and the cost of home construction today and the subsidy issue. So, the policy work that we're working on collectively here as part of the Homeownership Alliance is really important, right? Is how do we fill those gaps? So we think inventory is going to be a big part of that equation, is how do we build. Our migration report clearly is showing that the gentrification of Pittsburgh, we saw a rise in the median sale prices in Pittsburgh. We were on average about $145,000. Today, we're closer to $200,000 average. And in a lot of the communities we're seeing Black population loss, we're seeing sale prices of $500,000 and up today. So it really is a gentrification problem. And the migration is to lower wealth and lower tax cost cities in areas within Alleghany County and outside of Alleghany County. We have a couple more questions. What are some of the examples of a robust down payment assistance being combined with mortgage lending that is geared to increasing assets and income limitations of the demographics? So that's really a good question. What we're finding is utilizing the special purpose credit program initiatives and layering those together along with government and others. So like the Federal Home Loan Bank system has a good down payment program across most of its institutions. Unfortunately, that money goes really fast. Locally, I think they allocated $5 million in the last round, and I think it was spent within 30 days. We see taking these special purpose credit initiatives, one of our institutions targeted it to minority populations so that we could combine that with some of the new special purpose credit mortgage programs or even portfolio programs that many of the institutions have today that don't have mortgage insurance. They're underwriting to a credit score of 620 or 640. Their DTIs, they're pushing to 41%. Maybe even 50% on some of them, depending on how the household income structured and their credit spending management is happening. So with those things, I think if you can start to wrap a lot of these initiatives together, and it really is about educating ourselves and educating the banks and others of these programs so that their mortgage originators and others can talk about them more holistically. We found by just doing in Pittsburgh at our own table, not talking about credit per se or credit enhancement, but talking about household budgeting and really talking about all these programs and how to use them and how to layer them was much more influential in the numbers than it was spending time on teaching people how to fix their credit score, which is a much longer term process. And then be real about it. Most credit scores are low because of credit utilization, not about non-payment. So what you're finding is someone might get a credit card and use their credit card to the point where they have a $500 limit. They use it to the $500 limit on a regular basis. That has a 30-point spread on your credit report. Because soon as you go over utilization of that available credit more than 25 or 30%, your credit score is dinged. And most people don't know that. And just that kind of simple tools helps change this dynamic and changes the people that are able to then buy. The other question here is, does the heirs property challenge affect homeownership in Pittsburgh? Oh, yes. The tangled title problems and the clouded title problems are significant. I just had a story the other day of a poor family, woman, older man's living in his house of his parents. The roof is leaking. There's social service agencies in bringing Meals on Wheels and everything. And we can't get the roof fixed because he doesn't own the house. It's still in his parents' name. And so, now we're working with, to the credit of one of the larger institutions, we have an amazing organization in Pittsburgh called Catapult, led by a dynamic group of people. And they're doing a lot of work right now, got a significant grant to do tangled title and heirs work to help our families. You don't think it's that prevalent, but we're seeing a significant amount of it. Matter of fact, a lot of the properties that we are seeing coming into our land bank now have tangled title issues where the parents died, kids have been living in it. They have, the taxes are delinquent. There's no one to go after. And, until they move that property, it's not in their best interest to pay the taxes because it could lose it anyways. Does Pittsburgh Land Bank have the right to acquire property? Yes, so we recently modified the state. We did advocacy work across the state. So Pennsylvania is a commonwealth. It's a kind of a mess. So we had to petition for the second class city, which Pittsburgh's the only one in the Commonwealth. Philadelphia is a first class. We had to petition to change our tax law, which gives our land bank priority bid at all sheriff sales and treasurer sales. So that allows us to weed out the corporate bidder who could come in and try to take that property. That was a critical component we had to get in place and get past. It took us a good, 8 to 10 months to get the legislature educated on that and to get the Philadelphia delegation to help support passage of it. Second question here is the impact greater for Black communities on heirs? That's also a really good question. We are seeing significantly more in African-American communities impacted by heirs issues, mostly because families are dying, the owners and parents are dying without wills. And so what you have is multiple families. So under the laws in Pennsylvania, it would equally pass to the children. So if a parent dies and there are 4 children, maybe 1 is living in the house, 3 would like to sell the house, and you have the holdout, and they can't come to an understanding of how to dissolve the asset. It gets tied up in court, and in the end, these things just sit. So it is a big problem. It's primarily educating the population on the value of making sure you have a will, even if you don't have much. It does help, because otherwise this asset, in the end, if you don't declare it, could revert to the state, and the state then just take the wealth that that individual created.
Well, Ernie, thank you so much. I think we covered all of those questions. Always good information, and I think it goes back to a lot of education across the board. You're never too old to learn something, as they say. So thank you so much for the presentation and the information on your research and your recommendations. We're going to look forward to hearing how things pan out for you there in Pittsburgh. With that, I would love to have Elizabeth give us some updates on regulatory updates as well as legislative updates that we've been working on here at NCST. And with that, Elizabeth, I'll give you the floor.
Excellent. And thank you again, Ernie, for sharing your knowledge and your findings with us. You hit on quite a few different items that I'll cover in my policy overview as well. So always great to hear that our Homeownership Alliance members are aligned with NCST's policy priorities. The first that I'll raise that Ernie shouted out is the Neighborhood Homes Investment Act. So folks might very well be aware that NCST is one of the 3 co-chairs of the Neighborhood Homes Coalition. We manage a weekly advocacy group for national advocates, as well as a broader set of stakeholders. You can be local or you can be from the state. You can be, if you have an interest in a federal tax credit to be able to support affordable homeownership, the Neighborhood Homes Coalition is for you. So you can take a look at the link I've just put in the chat to learn a little bit more about the legislation. We have a kind of comment field or a place where you can be able to submit questions if you have them for us at the coalition, as well as interactive maps where you can see where this tax credit can benefit your community. So we hope that you can play around on that website. Another announcement that I think we covered on last SIB call, and you all might have heard within your own circles, is that the Department of Treasury actually announced $100 million for affordable housing supply. Very, very exciting. Something that took a few of us certainly by surprise, because if you were to ask me, how do I get $100 million for affordable housing supply? I'd say, well, you have to make sure Congress comes to an agreement, but Treasury found a way to be able to dole that out. So it is just an announcement at this point in time. I don't have any details. Rest assured, I'm knocking on the doors of the CDFI fund as often as I can to get a sense of what those details might look like, because we hope that they will, as they're piecing this program together, we'll take some of the recommendations that the Homeownership Alliance actually proposed in our letter that we sent to Secretary Yellen about 2 or 3 months before this announcement. So for any Homeownership Alliance members on the call, I hope that you are taking at least partial credit for this announcement, because were it not for the need that the Treasury had seen on the ground, thanks to our advocacy, I don't believe we would have seen this roll out. So we're very excited to have this coming down the pipe, because as Ernie had mentioned, capital is the name of the game. We want to make sure that nonprofit mission-driven organizations have the resources to be able to support affordable homeownership. And everything else I have to say is a bunch of regulatory things, so I'll try not to put folks to sleep, because it is absolutely relevant to our homeownership work. We started our week with submitting the Homeownership Alliance response to the Federal Home Loan Bank Mission Activities and Mission Achievement RFI. So the Federal Home Loan Bank has quite a few different items that are either open now for comment or have just closed. So on Monday, we submitted our comment letter to assist Federal Home Loan Bank in better tailoring what it is that their mission and metrics are to ensure that homeownership is not left out of that discussion. We are also actively engaged in the FHFA's and subsequently the GSE's Duty to Serve plan for 2025 through 2027. So here is the release from the FHFA. We are actively preparing a response on behalf of NCST. We occupy a very specific realm in the homeownership space where we're really looking at the distressed assets, and we really do believe that the GSEs have a broader role to play in that. So we are currently drafting that right now, and we also, NCST and the Homeownership Alliance, are members of the Underserved Mortgage Markets Coalition. This is a coalition that's managed by the Lincoln Land Policy Institute, and they have put together, with feedback from members like us and others, a duty to serve blueprint. So we are really going to lean on the coalition to cover a few other items that NCST won't cover in our individual letters. That includes maximizing usability of CDFIs, that includes manufactured housing, that includes single family development, and for those that it's relevant, multifamily and rental as well. Ernie also mentioned the Home Investment Partnerships Program, which is a very popular program for affordable housing development on the rental, on the homeownership side, as well as homeownership assistance and tenant-based rental assistance. If you are a homeownership provider and you have tried to use home, perhaps you've been successful, perhaps you have not. Certainly members in the Homeownership Alliance have lots of thoughts on how to be able to improve the home rule. And after years of waiting for HUD to take action on this very highly utilized, but still in much dire need of reform program, we now have that notice of proposed rulemaking that has been released. In 12 days, not that anybody's counting, we will submit our response as far as on behalf of the Homeownership Alliance, and we will base our response on the recommendations that our alliance had put forward a few years back on the home program. You can take a look at what some of our recommendations are going to be. We're going to have a listening session with our Homeownership Alliance members tomorrow. Myself and my team are drafting like the wind to make sure that this is what really seems like once in a couple decades opportunity to really help shape this important program so they can get it right for homeownership. There's lots of, again, really important uses, but homeownership is one that we feel like needs quite a bit more attention. We've got lots of ideas on how to be able to improve that process. Heading back to the Federal Home Loan Bank, as we're talking about access that nonprofits can have to different methods of capital, is the Federal Home Loan Bank has also released a request for input to improve the AHP program, or the Affordable Housing Program. So that's another effort that we will undertake as the Homeownership Alliance, through engaging with our members, through talking with our national partners, and really ensuring which lessons learned can be elevated in this comment that we will prepare. And if you are interested in any other regulatory items or any other legislative items, or just learning more about the Homeownership Alliance, I really do hope that you will fill out an interest form, or you can reach out directly to me. We are actively recruiting. We are so pleased again to have PCRG as a member. I think it was through one of the CIB calls that we got connected, and then we were able to find a deeper partnership. I do believe that any nonprofits that do homeownership that are on this call could benefit from joining the Alliance. So that is my pitch. Those are a lot of links for you to review. If you've got any questions on any of these items, please don't hesitate to reach out.
Thank you so much, Elizabeth, and Ernie, again, thank you. Lots of information to share, which we are happy to do, but also if there's something happening in your local market, let us know what's happening and how we can help. We are giving you a little bit of time back. Hang on, there's a question here. Will these links go out via email? Thanks for all of the great info. So we can follow up with that, and we do, by the way, I forgot to mention this at the top of the call, we do share the presentation and also the recording of this call on our website, and so we can look for ways to also share some of those links as well, so that you have everything in one place. Thanks for the question, Courtney. We are going to be off on August, or in August, the month of August. There is not going to be a community impact briefing call, but we'll see you back here in September. And so I hope everyone does have a good rest of your summertime. And please get in touch with us if we can help you with anything. But thanks again to everyone. And thanks especially to Ernie and Elizabeth for your updates. Oh, hang on. Yes. All right. Everything is, I think we've answered all the questions. Thank you so much, everyone.
Thanks,
Thanks,
all.
everyone.
Have a good one.